Welcome back, everybody. Right now, let's get some more from our guest host today, Jim Chanos, who is founder and president of Chanos Associates. And Jim, we've been talking about high-frequency trading today, whether or not these guys have an unfair advantage. Right. And there are different blocks you can put them into, whether they're paying to get to the head of the line at the exchanges, I think is one thing. Whether or not you can use your own algorithms, probably another. But since that conversation we had in the last hour, I've heard from someone who is a big value investor who says that he believes high-frequency trading front-running costs his clients 3 to 4 cents extra a share to getting competing trades. And he says a big hedge fund manager agrees with him on this. Do you think that's likely? Do you think that that plays out that way?
I don't know if he's talking about the rebate issue that we talked about off camera earlier or not. I don't know exactly what he's saying. But again, if you are a limit trader, you know, where you're, if I want to sell something short at $100 a share, and I give my trader an order, sell it short at $100 a share, he's not shorting it $99.97. So I'm not quite sure what it's referring to. If that's the way you trade, that's the way we trade. We don't turn our portfolio over very much. Once a year. That's glacial by hedge fund standards. So this world is somewhat alien to us.
He also brings up the idea, though, that just greater volatility, that is something that investors consider greater risk, and as a result, it costs more to raise money for businesses. There's not as much liquidity as a result.
Yeah, I mean, and if you're in the mutual fund business, I think that would have an impact because you have retail investors, we have institutional investors. So it all depends on your perspective on these things. I think going back, we get lost in the weeds. The issue is the fairness issue. Yeah. And I think that everybody could agree on that.
You probably can't stuff the genie back in the bottle and get rid of high-frequency trading altogether.
I think, you know, technology and trading goes hand in hand. There's always going to be someone looking for a better mousetrap. But as long as there's disclosure and it's fair, and if I have a better mousetrap, I should be able to make more money. I think people are fine with that.
Do you think there's anything to be said about what people describe as asynchronous information, meaning talking about being fair, that certain investors have more access to information than the retail guy?
Well, if it's
generally speaking,
if it's if it's order flow, you know, that is that inside information. I don't know. You know, if it's I'm analyzing financial statements better than you, that's the marketplace. So again, it depends on what the asynchronous information is and how valuable is it, and are we talking about, well, he has an advantage on me for a nanosecond or for whatever to get a half a penny. The average investor shouldn't worry about that. I mean, the average investor, your viewers, should not be worrying about that. The issue gets back, though, to fairness and the externalities that raises. And I think that's something we really need to be vigilant about completely.
Let's shift gears a little bit, because you talked at the very top of the show when you joined us at 7 o'clock about how you think central committees referring to China and central banks kind of go hand in and aren't going to be able to control this. We haven't really dug into what you think about QE3.
Yeah. I mean, I think I'd ought to disclose I sit on a Fed advisory committee, so these are my opinions. I'm concerned, as a lot of people are, that the Fed is really taking away marketplace signals. And by keeping rates artificially low or for long periods of time, we're distorting the marketplace. And one of the things the marketplace is good for is sending us signals that something's wrong. Fiscal
That's like a symptom, not getting signals. What about the dislocation? And I mean, what about the bubbles that result from when there's no signals, then you don't know?
And to open-end anything, don't you run the risk now, and it may be admittedly small, but it's there, that what do you do when this doesn't work? Right. And by the way, we're doing QE3 or QE infinity because 1 and 2 didn't do their job. And at what point do you start to erode the credibility of the institutions, you know, by increasing, you know, your mandate? And those would be the things I would worry about if I was sitting.
But isn't it all relative? If everybody's printing money, if Japan's printing money and we're printing money and Europe's printing money, does it really, when you talk about eroding the reputation or the credibility of an institution, if everybody's right, it's all relative, right?
Well, yeah, except
this means it'll be a global collapse instead of a domestic collapse.
You know, and you know, you will all own gold and a shotgun, you know.
Right.
But
you own gold?
I don't.
You own a shotgun?
That'll get you the gold.
No. But I think
been chased by someone with a shotgun.
These are issues. These are issues that I think really are.
Jim. Chanos, really, cynical sounds just like Chanos, and you know why? Because that's where it came from.
Yeah, well, but the cynics were.
But I read about you, and I wouldn't want this to be me. Contemptuously distrustful of human nature and motives. That's
that's the modern English derivation.
But you like to watch the world burn. I was right about that.
No. The cynics were seen as essential in the Greek democracy to basically cutting through the bull of the time, if you will.
Also, or, bacteria that decompose dead. I mean, everything is,
You're calling them bacteria.
I have no idea where you're going with this, but okay.
Well, they're essential, too, to keep, everyone honest, right?
Okay, but getting back to QE3, I mean, I think we're in uncharted territory, and, who knows?
And the exit word, we heard it was a 4-letter word, exit. And we have to take Bernanke's word for it that he can do this gracefully. And I don't know if he knows whether he can. Do you?
I don't know. I mean, exit what?
Exit all this balance is the size that you can pull back in all of this extraordinary.
Well, I mean, doesn't that present its own issue for the markets?
I thought that we went from the Volcker era back to the G. William Miller era on that day. Don't you think we went back to it's an inflection point?
It's clearly unprecedented, and I think we're going to see. We're in uncharted water.
You love it because it'll mean more doom and destruction. So
I want to get my steak dinner paid back
from Leisman.
Yeah.
You weren't going to bring that up. I promised him you wouldn't bring that up.
Well, I know. I mean, where is he? Is he hiding on me?
We're going to talk to another person on staff who we are dying to hear his take on this. Jim Cramer is getting fired up. He's going to talk China with our guest host today, Jim Chanos. We'll head down to the New York Stock Exchange right after this. Stick around.